Hello traders, welcome to this video. In this video, we are going to be discussing a powerful MACD divergence strategy. So if you are of the moving average divergence, but perhaps you are not very familiar with the divergence strategy, then you might want to watch this video till the end because we're going to be focusing on the divergence aspect of the MACD indicator. Okay, so we're just going to be looking at a step-by-step process on how to use this strategy for making smarter trading decisions, right? Okay, so first of all, let us add on the MACD to our chart. Okay, now after doing that, we need to understand that there are two main types of divergence. We have the regular divergence and the hidden divergence. Okay, so the regular divergence occurs when the price makes higher highs in an uptrend or lower lows in a downtrend. Okay, so when you have price making higher highs in an uptrend or lower lows in a downtrend, but the MACD line shows the opposite. That is lower highs in an uptrend or higher lows in a downtrend. So basically, for you to understand the concept, just know that in an uptrend, the usual structure is higher highs. That's the usual structure for an uptrend. And the usual structure for a downtrend is lower lows, right? But when you see the price making higher highs and the MACD indicator making lower highs, that is just the opposite, right? The opposite. And then in a downtrend, you see the price making lower lows and you see the MACD making higher lows. That's just the opposite. It shows a regular divergence. Okay, so a bullish regular divergence occurs when price makes a lower low, and the MACD line makes a higher low. That's what is called a bullish regular divergence, when the price is making a lower low and then the MACD is making a higher low. And we can see an example here. Price was making a lower low, the MACD made a higher low. You can see that's called a bullish regular divergence. Yeah, this signals that selling pressure is weakening. This signals that selling pressure is weakening. Okay, and a potential bullish reversal could occur. Now, as for a bearish regular divergence, it occurs when price is making a higher high. When price is making a higher high, but the MACD is making a lower high. Okay, when price is making a higher high but the MACD is making a lower high, so that signals that buying momentum is fading. Okay, and it shows that there could be a potential bearish reversal. So it's just the opposite of the bullish regular divergence. Okay, I was just checking if I could find an example of a bearish regular divergence, but I'm not exactly seeing one yet. Yeah, so in order to save time, I think we're just going to proceed. But just to say it again, as for the bullish regular divergence, it is lower lows on the price and higher lows on the MACD. Then for bearish, it is higher lows, higher highs, sorry. For the bearish, it is the highs we use. One thing you should note is for the bearish divergence, for the bearish regular divergence, we use the highs. And for the bullish regular divergence, we use the lows. Okay, we use the lows. Then for a bearish regular divergence, we use the highs. So for a bearish regular divergence, price will be making higher high. Price will be making higher high, while the indicator, the MACD, will be making lower highs. Okay, so now how do you use the regular divergence? When you spot a bullish divergence, you wait for the MACD line to cross above. Okay, you wait for the MACD line to cross above the zero line. Okay, yeah, so that is going to confirm the upward reversal. On the other hand, for the bearish divergence, you wait for the MACD line to cross below the zero line before you enter your short trade. So since we found a bullish regular divergence example, so we're just going to use this example. So now we can see that right after the divergence occurred, at this point we saw that the MACD line had crossed above the zero line, so we would have considered entering a buy around here, and then our stop loss, okay, somewhere around here. That was when the cross happened, somewhere around here. Now stop loss would have to be below the previous swing low, but we can see that eventually the price went up. You see that this was a valid divergence because the price eventually went up. It showed a bullish reversal. So if we had entered somewhere around here, set our stop loss here, we would have caught about 500 pips. Yeah, would have ridden the price all the way up to this point, all the way up to this point. You can use resistance zones to as exit signal. So the price rose all the way to this resistance zone. Now we could have possibly exited the buy trade. Okay, so it's important to combine your signals from the divergence with support and resistance levels or candlestick patterns for better accuracy. Okay, so the next kind of divergence is the hidden divergence. Now the hidden divergence occurs when the price is making a higher low in an uptrend. In an uptrend is making a higher low but a lower low in a downtrend. So in an uptrend, unlike the regular divergence that we have lower lows for bullish and higher highs for bearish, in the hidden we have higher lows for the bullish, right? The hidden divergence somehow follows the regular structure of a bullish trend and a bearish trend. So you would actually see a higher low in an uptrend and you will see a lower high in a downtrend, but the MACD shows the opposite. So you will be seeing a lower low in an uptrend for the MACD and a higher high in an uptrend for the M for a bearish trend. That is, for a bearish trend, you will see a higher high on the MACD and you will see a lower low on the MACD. The lower low is for the uptrend and the higher high is for the downtrend. Okay, so a bullish hidden divergence, price makes a higher low. You need to know the difference. In regular, price makes lower low, but in hidden, price actually makes a higher low. Okay, the price makes a higher low, but the MACD line makes a lower low. This indicates that the current uptrend is likely to continue. You note the difference. While the regular divergence signals a potential reversal, the hidden divergence signals a potential continuation. So that's like the major difference, right? So let us see if we can find any bullish hidden divergence where we have price making higher lows, but the indicator making lower lows. Let's just see if we can find that. Yeah, divergence is not something that might occur always, but yeah, it do happen, but you might not always find it on the chart. So whenever you find it, it's a great signal, right? Okay, I don't think I can find it anywhere here right now. Okay, can't really find that anywhere here right now. Just look a little bit more. Okay. Okay, I couldn't really find that now. So let's check if we're going to find an example for the bearish hidden divergence, because the bearish hidden divergence occurs when price makes a lower high, but the MACD line makes a higher high. Okay, so let us see if we can find an example for bearish hidden divergence. Price makes a lower high, but the MACD makes a higher high. Um, just looking for example. Okay, this is not exactly an example because it was a higher high we had here. We also have a lower high on the price chart, on the price, and then a higher high on the MACD. Okay, this is becoming quite hard to find. Let me go to another time frame to know we can find such. Okay, I think the lower high, and yeah, I really wanted to display a real example, but it seems like divergence is not very common on this chart at the moment. So just to save time, we're going to skip it. But just know that in a bullish hidden divergence, price makes a higher low, and the MACD line makes a lower low. The MACD indicator makes a lower low, while on the bearish hidden divergence, price makes a lower high while the MACD makes a higher high. Okay, so how do you use hidden divergences? For bullish hidden divergences, you need to enter a buy position where the MACD line crosses above the zero line. So when you notice the MACD line crosses above the zero line after the divergence has formed, it's a good opportunity to enter a buy. For a bearish hidden divergence, you wait for the MACD line to cross below the zero line and then you enter a short trade. Okay, so for example, if you have an uptrend and price is making higher highs, but the MACD is making lower highs, okay, you might be looking at a potential bearish reversal. That is when price is making higher highs and MACD is making lower highs. That's called a bearish regular divergence. Okay, you need to understand the difference, right? And similarly, in a downturn, if price is making lower lows and MACD is making higher lows, this could signal bullish reversal. That is a bullish regular divergence. Okay, then in terms of hidden divergence, in an uptrend, if price is making higher lows and MACD is making lower lows, the trend may continue upward. So you could still be looking for buy opportunities. And in a downtrend, if price is making lower highs while the MACD is making higher highs, the downward trend could be about to continue. So you could still be looking for sell opportunities. Okay. So when you are using the MACD divergence, you should try as much as possible to avoid fake outs because fake outs are common in trading, especially around major support and resistance zones. So the MACD divergence strategy can help you filter out these fake moves. As for the regular divergence, it helps you identify when the current trend might be running out of steam. So it's warning you of potential reversal. But while the hidden divergence shows when the pullback is just a temporary retracement in the trend. So it allows you to stay in the trade and avoid getting shaken out. Okay. Now, um, that's basically how the divergence works. You can use it as an additional tool in your strategy. You might not always find the divergence show up on the chart, but whenever they do, they can be really effective. So I hope you found this video insightful. Kindly like and subscribe for more trading insights, and don't forget to hit the notification bell so you don't miss out on more trading updates. Cheers and happy trading.